Good afternoon, everybody, and welcome to Cliffwater's Direct Lending Index quarterly webinar. I am Fran Byers. I'm the head of capital markets at Cliffwater, and I'm joined today by Steve Nesbitt, CEO and CIO at Cliffwater and creator of the Cliffwater Direct Lending Index. Cliffwater is an alternative investment advisor founded in 2004, and we are active across the alternatives investment spectrum, currently advising on or managing over $100 billion in alternative assets. Just a few things to note before we get started. This is the Cliffwater Direct Lending Index quarterly webinar. It is intended for our clients and investors, and we will not be discussing the Cliffwater funds on this webinar. This webcast is meant to be confidential, and it is intended for qualified and sophisticated investors. It is not meant to be an offer or solicitation for the purchase or sale of any security. And the information and opinions we will discuss here are not investment advice. There is no assurance that any expected rate of return, risk, or yield will be achieved. Please submit questions at any time using the Q&A button on your Zoom toolbar, and we will answer as many as we can as time permits at the conclusion of our prepared remarks. Steve is going to kick things off and give you a review of the CDLI 4Q22 and full year results. And I will follow him with a 2023 outlook and provide some insight into the new issue market and market conditions we're seeing in the direct lending market. And with that, Steve, please take it away.
Hey, thanks, Fran, and thanks everybody for joining us today. As Fran described, probably spend 15 minutes just looking in the rearview mirror as to what happened in the middle market in 2022, focused on our index, and then turn it back over to Fran for the hard part, looking at ahead, what our outlook is for 2023. Just briefly to describe the index, basically we created this index in 2015 as a way to measure what's going on in the direct lending market, the middle market. It was, again, published and started publishing it in 2015. It backdates to 2004. Basically, we get all the information from filings by BDCs to the SEC. The sample set is well over 100 now, representing 12,000 loans, $263 billion. I think it's a very good sample set. It represents about a third, 30 to 35% of the entire middle market. It doesn't suffer from backfill bias and reporting biases that sometimes hurt other alternative indices. I apologize. We just sent it out, the Q4 numbers, a few days ago. Normally, we can publish within 45 days after quarter end, but the information comes from 10Ks rather than 10Qs this quarter, so it takes a little bit longer for those to report. Importantly, the index is total return index. We also report three components I'll describe later: income, realized losses, and unrealized gains and losses. And we also provide a lot of fundamental information on those underlying loans, which I'll talk about. We have two sub-indices. The flagship index is the Cliffwater Direct Lending Index, CDLI. We do report subsets. So we have CDLI S, which just includes senior loans, and CDLI V, which are venture-backed loans. So just to describe what middle market loans are quickly, basically they comprise three different types of loans. One is representing a good part of the index are senior secured loans, is represented in that first larger block at the top. There are also second lien or mezzanine loans in the index. And third, there are what we call unitranche loans, which really combine first lien and second lien. Sometimes revolvers are involved. Most companies use banks for their revolvers, but as well. Some of these loans also include revolvers, so that can be part of our part of the index, but a very small proportion. On this page 4 of the slide deck, basically the CDLI is about total return, and it's 3 components. The most important component is the income return. This is a growth of $1 chart going back from inception of the index, and you can see it's almost a straight line. Income produces a steady stream of significant cash income. The combined return of income over this entire period is 10.74%, kind of the average yield over this entire time period. Investing in middle market loans is pretty easy. Clip the coupons, collect the interest income, and avoid defaults. Sometimes defaults occur that generates losses. There's a recovery rate, so it's basically default less recovery. If you look at this chart, the red line displays the degradation in $1 from realized losses. Okay, in the red line, those have averaged minus 1.04% over the 18-year history of the index. So basically, you're capturing 10.74% in income. You're losing 1% of that in realized losses. That gives you a total return of 9.31%. That equation doesn't exactly work because there are unrealized gains or losses over this time period. We had unrealized losses of 32 basis points. Unrealized losses will basically go away or translate into realized losses over time. So the equation is basically simple in the case of middle market loans. And here are the numbers going back to inception and calendar 2022. So the second column is trailing 4 quarters. That is the calendar year 2022, 6.27%. Very good year. Relative pretty much any other asset class for middle market loans, but below the long-term average of call it 9% plus. The reason for the lower return in 2022 was not realized losses. It was a pretty quiet year. But unrealized or markdowns in loans of 2.61%. So overall, basically, this truly demonstrated the all-weather characteristic of middle market loans and the index. So I'm going to run through the components. Start with what basically drives the index, and that is income. There are 2 measures of income that we use that often get confused. Current yield, which is loan income divided by price. And then go halfway down the slide here, yield to maturity, which is current yield plus the amortization of the difference between the price and par value of the loan. Sometimes these get mixed up, and I want to spend some time talking about that. But let's start at the top. Current yield, which is what we often cite, is loan income divided by price. As I said, loan income is cash interest, also PIK interest, payment in kind interest, OID. And for most of these loans, you might write a $100 million loan, but you only need to fund it with call it $97 million. And that's an extra return that's generally amortized over the life of the loan. Plus, sometimes there are fees associated with these loans, not management fees, but fees associated with underwriting the loan. If there's a prepayment, it's prepayment penalty, these kind of things. Cash interest is floating rate. That's why we like these loans, the net fixed interest. So it's a SOFR base rate plus a spread. I talked about payment in kind. Payment in kind represents approximately, as I'll show you later, about 7% of the total interest cost. So if interest income is 10%, basically 70 basis points of that is payment in kind. OID averages about currently about between 2 and 3%. So if you look at yield to maturity, again, the difference here, it amortizes the difference between loan price and principal value. Loans are generally valued on a quarterly basis by an independent valuation firm. Then you amortize that over the effective life, which is generally 3 years. So you can calculate what we call the 3-year pull to par yield to maturity. And basically that difference between the loan price and par value is amortized over that 3 years, the expected life of the loan. Slide 8 here, for both the CDLI and the broadly syndicated leveraged loans represented by the Morningstar LSTA index, I show both yield to maturity and current yield. So you can see the current yield is generally lower than the yield to maturity. It's probably why managers like to report yield to maturity rather than current yield. And the reason for the difference is most of the time these loans trade below par value instead of above par value. I use the same scale here, so you can also see the relative difference in yields between CDLI and leverage loans. And the takeaway at the bottom of the page is basically, the middle market represented by the CDLI private loans generally yield about 500 basis points or 5% above the broadly syndicated loans. And so, at least for our clients, when we're recommending direct lending, basically on a gross and fee basis, we're hoping to capture 5%. Here's a direct comparison between the CDLI or private middle market loans and high yield bonds and the Morningstar broadly syndicated leverage loan index. And on the top we show current yield, okay, and again this is the more conservative calculation, and it's conservative in the sense that basically the price is trading below par. The assumption is that there's not going to be a pull to par. It's going to bake in expected losses reflected in the price. So here, the current yield, the average difference between the CDLI and the leverage loans is about 600 basis points. Looking down at the bottom, yield to maturity, you still see that difference. However, the gap closes generally when the broadly syndicated markets trade way down, as they have over the last few months. So the gap has narrowed, but it's still significant at about 200 basis points. The long-term average spread is 550 basis points, similar to the difference between those same two yields for looking at a current yield basis. Staying with yield here, this shows the long-term history of interest income for the CDLI. The average is 10.74%. So instead of comparing against broadly syndicated loans, we're trying to measure the risk premium. So we compare that in that dashed line to the T-bill yield. On average, over this entire period, the real yield premium over T-bills has been 9.57%, very significant. However, I just caution people, this was a period where for a lot of this period where the Fed kept interest rate, short-term rates at zero. we probably don't expect that same differential on a go forward basis, but we do expect something very, very significant, at least as significant as what you see in most other asset classes. Setting aside interest income, the main driver, long-term realized losses are the major detractors. So I'd like to talk a bit about that now. So here we show trailing 4-quarter and cumulative realized losses for the index. And again, these realized losses reflect defaults, okay, in middle market loans, offset by recovery. So it's net credit losses. So you see the pattern on the bars on this chart over time from inception of the index. Early before 2008, there were some net realized gains. Pre-2008, there were quite a bit in terms of shadow equity in the index in the form of mezz, second lien holdings. After that, after 2008, it gravitated more towards senior secured and true second lien loans. But you can see most heavy losses during 2008. That was a 3 sigma event. That's what we would call the worst case scenario. Since that time, there have been intermittent drawdowns. There was the Euro crisis during 2011, 2012, the oil crisis, 2015, 16, 17, COVID, 2020. And if you look at the far right-hand side, things have been pretty quiet over the last couple of years. We've had some unrealized losses over the last year. I'll talk more about that later, perhaps in anticipation of a recession. But cumulative losses, 17.3% over the index's life, which translates into about 1% per year. So basically, what we like to say, if you're throwing darts at managers, subtract 1% from their yield, that is their gross of fee expected return. More detail, I'm not going to spend any time on this chart, but I wanted you to have as a reference actual default rates, recovery rates, credit losses for high yield bonds, broadly syndicated leverage loans, the CDLI, and I add on the far right-hand side, commercial and industrial loans. These are balance sheet, largely balance sheet middle market loans for U.S. banks, and basically you can examine the track record, but of each of these. But basically, we like to say, hey, expect a loss rate for middle market loans similar to leverage loans, probably syndicated loans. There's not much difference between the two. High yield bonds, generally the loss rate is 0.5% higher, and commercial banks, it's hard to predict on these. They got jammed up obviously in 2008 with losses of 20%, mostly related to loans to real estate companies, and but since that time they've gotten their loss rates down no more in line with the broadly syndicated and middle market. Just quickly on unrealized losses, this is the point I continue to try to make. Unrealized gains and losses or markdowns are really, I consider them loan loss reserves. So there's no interest rate risk here. So if loans are falling in price, it really has to do with expectation of defaults. And you see this here on this graph. So let's look at the financial crisis. So early in the financial crisis, there were large number of unrealized losses. Okay. After 2008, two things happened. Those unrealized losses went to two places. They were offset by unrealized gains. Those loans were marked up because they were the valuation firms thought they marked them down too much, or they went to realized losses. And so realized losses, as you can see in red, generally occurs subsequent to the unrealized losses. And if you look at the three major periods, oil crisis, COVID, end of 2008, generally unrealized losses overestimate realized losses by about 100%. Or in other words, realized losses end up being half of what the markdowns are predicting. Okay, and if far right hand side of this chart, right now we're looking at 2.61% in unrealized losses for 2022. So basically, the market is predicting some realized losses ahead. Generally, they overestimate. So I look at this number and I say, hey, if I'm going to predict, I'm going to predict realized losses of 1.3% for the index on a go-forward basis. Turning to total return, I'm going to fly through a couple charts here. So basically, these are 4-quarter returns for the CDLI. This is a pattern return stream that looks very attractive for just about anybody who's doing asset allocation. The exception was the 3 Sigma 2008, where the index was down 6%, and ending in 2008, which was, would have been a very good outcome compared to any other asset class except treasuries during 2008. Again, the annual numbers, if you want to reference those, and again, low 2022 is 6.3% against the historical average because of unrealized losses or markdowns in the portfolio. Just quickly, non-accruals remained low, below the long-term average. Recovery rates are about this, are at historical levels, so nothing alarming here. The index continues to be dominated by senior secured loans, both true senior and unitranche, at about 78%. Kind of expect that to continue to go up over time. The real change to note is in the fourth quarter was an increase in the effective life. We were running at about in the low 2s. Now we're above 4 years. What this means is the liquidity of a portfolio of middle market loans has been going down steadily, and the impact or the reason for that is low M&A activity. So there's not a lot of refinancing, corporate action, and so basically, cash flow from maturities or refis or whatever have gone down. So the effective maturity has gone up, and so cash flow, not from cash income, but from the principal, is now running at 20 to 25% rather than 35 to 40% a few years ago. Diversification, obviously strong industry diversification for the index. There's not really any exposure to banks. Banks have a lower cost of capital than direct lenders, so there's not a lot of bank lending. In terms of pricing, we show this chart. Prices have gone down. They're below par value, which would be 100. What's typical is for the broadly syndicated market, they trade down more, and the high yield bond index is trading down a lot more because it's fixed interest. So that it's more interest rate risk than it is credit risk. But we break down the CDLI into seniors, second lien, and other, basically to show pricing within the index subgroups. PIK income, as I said, PIK income has been on the rise over the last few years, particularly during COVID, it became double digit, but it's has settled in recently at about 7%. We talk about our two sub-indices, the senior index and the venture index. Here we show the senior index against the CDLI. It's a shorter time period that the senior index is available back to 2010. You give up on yield. So the positive and negatives are with the senior loans, you give up on yield. You make some, but not all of it back on lower loss rates. Okay. The other good thing about senior loans is if you want financing, if you want to boost return through borrowings, the cost of borrowing is much lower for senior loans than the others. So, I think there's there's always a big discussion. Should I do senior and use leverage, or should I go second lien and mezz and just not lever? So that's always a discussion point in portfolio construction. On the venture side, we're still like venture debt, even in the current market environment, if you have the right manager. We're definitely going to higher yield. Loss rates are not higher. But then again, the stress period, I wish we had an index going back to 2000 to 2022 when venture got hit hard, but we just don't. So venture lending looks attractive, but with the data, we wish the data set was longer. With that, let me turn it back to Fran to talk about what we see ahead here. Go ahead, Fran.
Thanks, Steve. So as Steve showed in our 4Q CDLI return data, direct lending obviously had a very respectable 2022, particularly when you compared it to the public benchmarks. Direct lending once again proved it's an all-weather asset class despite all the market-wide challenges that we saw throughout last year. I would have to say the broader markets have kicked off in 2023 in a very similar fashion as 2022, with meaningful volatility, and now we have new challenges. While inflation is slowly improving, it's still too high. This is resulting in continued interest rate uncertainty, and now we can add bank failures to the list of challenges this year. This is causing systematic concerns, it's increasing recession fears, and it's hurting investor confidence. So in light of this, I just wanted to give you all a glimpse into how direct lending market will be faring so far in the first quarter of 2023, and perhaps provide you a few ideas what we're watching in terms of opportunities and challenges this year. So starting right here on this slide, let's start with inflows into the asset class. While I would describe flows in most other liquid asset classes as somewhat precarious right now, investors are obviously still allocating capital to private credit, despite all the macro pressures and the volatility that the market is facing. Looking to the chart on the left, you can see the parabolic growth in the CDLI's AUM post-COVID. The borrower count has nearly doubled from 6,000 borrowers to close to 12,000 borrowers. And the AUM growth that we have seen in our space is probably the strongest growth rate of any other category within alternatives. Global private credit fundraising, highlighted in the chart on the right, peaked in 2021. It certainly started to slow somewhat in 2022, particularly in the back half of the year, but it still came out the second highest year on record. And while there has been an acceleration of volatility this year in 2023, resulting in strong outflows from both the bond and the loan markets week to week, inflows into private credit are still continuing, albeit at a slower pace than the last 2 years. Obviously, you can see here mezz is grabbing a lot of dollars because it's a more counter-cyclical asset class and it thrives in dislocated markets. But even regular way direct lending is still garnering much support. The strong US dollar, the desire to hedge interest rate risk, the resilient and defensive nature of direct lending portfolios, the strong returns, the low level of losses, the low NAV volatility compared to liquid markets, and the consistent and robust illiquidity premium that the asset class generates continues to keep investor interest very high in private debt. Steve, if you can flip to the next slide, we can move on from demand and talk about supply. No matter how you slice the data last year across markets globally, whether it was investment grade, high yield bonds, institutional loan volume, issuance was simply way, way down. And despite the unprecedented amount of capital that private equity has raised in the last 4 years, PE shops were no exception. You read the headlines about investment banks taking meaningful losses last year due to the hung deals, while the institutional loan and high yield bond markets effectively shut down in the back half of the year. And you can see the impact in this chart on the left, which highlights syndicated private equity volume fell a whopping 52% last year. And while the syndicated market certainly started out stronger this year in January and February, recent events following Silicon Valley Bank's demise has only further set back this market. Meanwhile, it was direct lenders that benefited from dislocated markets, as you can see in the chart on the right. Both middle market and large corporate unitranche direct lending issuance together reached the second highest year on record in 2022. What does this mean? Not only are smaller middle market deals more stable than larger deals, but the long-term locked up and sticky capital base of direct lenders allows these platforms to invest in both good times and bad and capitalize on market dislocations and be a safe haven for borrowers looking to transact. Steve, if you could flip to the next slide. That being said, we can see that the deal flow picture in 2023 has become far more challenged and slowed. Of course, 1Q is always a bit slower than other quarters in the direct lending market, but what we are seeing now is more than just a seasonal downshift. The chart on the left highlights a market survey from Refinitiv, basically collecting sentiment from direct lenders on deal volumes. Those lenders that took the survey back in December were largely optimistic that loan volumes were going to pick up in the first half of this year. But following recent market events related to the banking crisis and in looking at their pipelines, we can see that in March, most market participants have dialed back their expectations for deal flow this year, with most lenders believing supply will be constrained and putting money to work will be more difficult. Furthermore, rising rates, volatility, and slowing global growth makes the math more challenging for private equity. Lenders are dialing back their leverage levels they will offer to borrowers, and we are starting to see signs of enterprise value compression, which is highlighted in the chart on the right. While you might think EV multiples coming down is a good thing, it causes what we call a buyer-seller disconnect, as sellers want yesterday's price and buyers cannot make the math work, causing a bottleneck and slowdown in new money activity, particularly in new LBO buyouts. Furthermore, recession fears and macro uncertainty never bodes well for M&A deal making. And if revenue pressures set in due to macroeconomic weakness later this year, the math becomes even more challenging. So we should expect that the abundance and record amounts of deal flow that we saw between 2021 and 2022 is very unlikely to be repeated over the near to intermediate term. So Steve, if you could flip to slide 33, what does this mean for the direct lending market? Well, if lenders continue to have strong inflows, but supply is not sufficient to match it, you start to see more competitive dynamics in the market, and terms can gravitate back towards borrowers rather than lenders. However, we're also in a period of uncertainty, and volatility and those dynamics typically prevent spreads from tightening. So basically what we have is a bifurcated market and a flight to quality. The best credits, the highest conviction and safest credits will be the most competitive and garner better terms, while the weaker, tougher credits will continue to price wide. And we are likely to see pricing somewhat range bound this year as the levels shown here in the first quarter of 2023. So looking to the chart on the left, we show you here the average first lien spread over the past 6 quarters across the size spectrum of direct lending. We can see how spreads have risen every quarter over the past year and a half. Spreads rose dramatically the most on the mega unis, as evidenced by the large corporate bar here, given the select group of direct lenders that can hold $500 million plus on a single transaction. Some of those lenders have moderated their holds in recent months, and so you've seen pricing really increase in that market. But no matter which size segment we look at, these increased spreads bode really well for the end investor, obviously, because it signals higher amount of interest income is coming into the funds, and that will ultimately be passed on in the form of higher returns. But in the chart on the right, we can begin to see signs of supply-demand imbalance in the dark blue bar, which represents sponsored first lien loans. where it has tightened modestly so far in the first quarter versus what we saw in the fourth quarter. Meanwhile, the riskier parts of the market, for example, recurring revenue loans or non-sponsored lending, continues to see higher spreads and premiums as there are less lenders willing to finance that level of risk right now. So lenders rather gravitate to the safer, regular way sponsored backed deals that offer equity support and better cash flow metrics. Fast forwarding to slide 34. We can see a similar theme when we look at structures and leverage levels across industries. While all credits and sectors are delivering double-digit unlevered yields to their bottom line in the chart on the left, we can see that some of the more cyclical or CapEx-sensitive sectors, such as consumer or industrials, are producing much higher yields. And in the chart on the right, those same sectors are being structured with lower leverage points to compensate lenders for the fact of where we are in the cycle and the macro uncertainty. Compare that to more defensive sectors, such as technology, where many lenders are finding safety due to the high margins and the sticky and entrenched customer base that software credits provide. That sector is seeing modest yield tightening and continues to obtain higher leverage points. The positive here is that direct lenders are being thoughtful about the returns they expect to achieve and the structures that each sector warrants. These lenders are buy and hold. How they structure and price these deals going in is immensely important to investors having a good experience. And it is a big factor as to why this asset class consistently outperforms the liquid loan market every year. Moving to the next slide. We cannot ignore, though, the impact that rising rates has on a borrower's health and interest coverage ratios. Obviously, looking into the slide on the left, we can see how interest coverage ratios on new deals is on the decline with each passing quarter, as both spreads and base rates rise. But despite the weakening of this metric, we have yet to see a commensurate pickup in distress or default in the space, as Steve highlighted earlier. Many investors are asking, how are borrowers able to withstand these rates? And you heard many managers say on earnings calls, interest rates alone do not cause widespread defaults, although we do expect the default environment to deteriorate if rates stay high for longer. Sponsors and lenders are trying to find creative solutions to allow borrowers to weather these higher rates and continue with their M&A strategies. One example, Steve showed the PIC chart earlier in the presentation being at a relatively stable level in 4Q, but we do expect that PIC chart will start to show an increase with each passing quarter in 2023, especially if base rates keep rising. Meanwhile, sponsors are finding creative non-cash pay solutions in the form of structured capital or preferred equity to inject capital into strong borrowers to finance M&A. You're seeing this in the chart on the right as more sponsors seek out this capital to preserve their returns. This allows companies to acquire EBITDA without adding debt or exacerbate a borrower's interest burden. It can help modestly delever companies, balance sheets, or provide growth capital that doesn't constrain cash flows. Moving to the next slide, we can end on portfolio health and where we are seeing pressures within the CDLI. Steve highlighted earlier that the non-accrual rate, while somewhat higher in the fourth quarter, is still at historically low and benign levels. You can see this again here in the chart on the left, which highlights default volume or new loans that are placed on non-accrual status within our index. We can again take note that the trailing 4-quarter default rate remains well below historical levels, illustrating how immensely strong our economy was coming out of COVID. But we can also take notice that the default rate is at an inflection point. It's starting to tick back up. In the chart on the right, we highlight the 6 sectors that make up the bulk of the CDLI index. Each sector is showing a very modest rise in the non-accrual rate, as you would expect as the business cycle progresses. But where we saw the most notable pickup last quarter was in venture lending and healthcare. Technology tends to be one of the lowest default and loss sectors, which is why it's the #1 sector by exposure in direct lending and within the CDLI. But that little jump you see there from 0.3% to 0.5 is a meaningful increase because the dollar amount represented is high here. And it was exclusively driven by venture lenders within the index. Crypto is also included in that number. Similar to what we saw with Silicon Valley Bank a few weeks ago, some of these venture borrowers are more vulnerable, given the meaningful drop in valuations over recent quarters. Many of them have a high cash burn. Some will be unable to raise their next round of equity financings to repay their debt. And we could continue to see pressure in that space within the index with each passing quarter. Meanwhile, healthcare has been the other notable theme driving a pickup in defaults in our index. Another beloved sector within the CDLI, giving the defensive nature of healthcare. But the stress has been more idiosyncratic to that industry and less GDP economy driven. Doctor fatigue, labor shortages, wage pressure challenges following COVID is pressuring margins. It's also resulting in lower capacity, which hits revenue. Medical supply costs were also impacted by inflation. Couple that with aggressive roll-up strategies due to the abundance of PE capital thrown at the space and difficult integrations that perhaps don't go to plan. Top it off with payment and reimbursement risks due to complicated healthcare systems. These themes have largely been to blame for the pickup in stress in this sector, rather than what's going broadly on in the economy and with interest rates. These pressures aren't unique to just direct lending. It's happening in the institutional loan market, where 25% of all healthcare names are trading below 90. The good news is that outside of these two sectors, the market continues to see strong top-line growth. The challenges that was stemming from supply chain issues and raw material costs are starting to abate. And most borrowers within direct lending universe are super defensive credits. They have cost-cutting levers they can pull to manage their liquidity and withstand the margin compression environment, which is how lenders have kept defaults low to date. And while recession fears are accelerating, and economists and strategists are putting out wildly different default rate expectations for both loans and bonds over the next 6 to 18 months, keep in mind that direct lenders continue to have an advantage over those markets. Tighter docs, greater levels of lender camaraderie in a workout situation, covenants, which put them higher up in the queue to get equity capital, deep and repeat sponsor relationships, top of the capital structure portfolios, and a disposition towards defensive through the cycle industries and borrowers. Last point on me, just on Silicon Valley Bank, since it's recent and what this could mean for direct lenders, because we've gotten a lot of questions on it. While in the short term, the direct lending market came out of this banking crisis pretty much unscathed and was able to find immediate solutions to keep their businesses running fluidly, there are both good and bad repercussions over the intermediate to longer term. And many of these issues that caused these bank failures are still present in our system. On the positive, direct lenders will continue to take and maintain meaningful market share on new issue loans away from commercial banks, the investment banks, and the syndicated loan market, since though we are unregulated market, assuming that continues, and have long-term sticky and locked up capital, both of which makes direct lenders more reliable financing partners. On the flip side, as regional banks are at risk of losing their deposit base and are highly likely to be subjected to more heightened regulations and capital requirements, which can increase their cost of capital, direct lenders may not be able to access as deep a financing market from regional banks at the same terms they were able to garner over the last 2 to 3 years. This most recent banking crisis highlights to us all the need for direct lenders to diversify their funding sources and not solely rely on regulated bank credit facilities to lever their business. That is it for our prepared remarks, and we can take a few questions.
Fran, I had, thank you, that was excellent. There was some straightforward questions, and which I'll try to handle, but if you can just jump in if I get these incorrect. Median and average size of loans in the index. So I need to shoot from the hip a little bit here. We can get those numbers, but I think the average is a little over 200 million average size loan. The median is probably more, a little over 100 million, but we'll follow up and give you those exact numbers. We report EBITDA in this presentation of the underlying portfolio companies. As the questioner appropriately said, that's not generally reported in the 10Qs and Ks. So how do we get that data? There are really two sources. If you listen to the presentations, apart from the 10Ks, so the quarterly presentations from underlying lenders, they'll generally give you that number. In some cases where they don't, we call and get those numbers. I think, Fran, you had bucketed some EBITDA numbers and allocations, and we may get that from a different source like PitchBook or I can't remember where we had it here. From Refinitiv or PitchBook, some other source we may use other than 10K filings.
Yeah, and
Is
at
that correct,
Cliffwater, well, some of the data is from Refinitiv, but a lot of the pricing and leverage metrics, we track the market across the Cliffwater platform, right? So we're able to see, on our advisory side of the business and our entire business, we're deeply entrenched in the market, and so we're able to see and bucket terms that way.
Yeah. And then we had a question here on realized losses. So let me just make a couple of comments on that. So if you look at high yield bonds and broadly syndicated loans, they'll report on a monthly basis. They'll report defaults and they'll report recoveries, and multiplying those two, you get credit losses. Their recovery rates, by the way, are not true recoveries. They basically take the price at the end of the month, and they assume that that's going to be the recovery rate. So it's basically what you can sell the defaulted loan at or bond at the end of the month. It's different with middle market loans because these are buy and hold. We know because it's reported what credit losses are in the 10Qs and Ks. Those are realized losses. So we have to basically infer what defaults and recoveries are from those credit losses. For the recovery rate, we basically use data on non-accrual status. We'll take what their end of quarter valuation is vis-a-vis what the par value is. So basically they give us what the recovery rate is. So knowing the credit loss, knowing the recovery, we can infer what the default rate is. I will say in the middle market, because of covenants and such, there are a lot of technical defaults that are not necessarily money defaults. So it's a little more difficult to follow a process similar to what they do in the broadly syndicated market. And then finally, Fran, I'll give this to you. A question on, hey, private credit ecosystem over the next 3 years. What do you see? How will the world look different 3 years from now than it looks now as it relates to private debt, in your view?
Yeah, I mean, everything's positive. There's a lot of tailwinds for the private credit space, and I'll hit a couple points. First off, if you look at the projections of growth in this market, people are estimating, okay, we're at like 1.3 trillion today, and they're estimating very rapid growth over the next 5 years. Many data providers and publications are saying we could see this space double in 5 years, which is a positive. Direct lending's been around. It really started to pick up post GFC. We really started out focused on institutional clients, big pension funds. You're now starting to see direct lenders branching out globally. They're going into the wealth channel. In particular, wealth has been underallocated to the asset class. And I think over the next 3 years, you're going to see more products, more interesting structures that are tailored to the wealth market, which is a $25 trillion market in the US, high net worth market. So I think for wealth, there's going to be a lot more opportunities to get access to this space. What I really like about direct lending is with each cycle and with each passing year, direct lenders gain more experience. They get bigger, they get better, they get more capitalized, they get smarter, they move into higher quality loans. And so, a lot of the losses that we saw earlier coming out of the GFC, really the space has evolved in a huge way to move to more safety, better credits, bigger deals. We'll talk about the broadly syndicated market. We're only at scratching the surface in terms of having direct lenders be able to take market share from that market. I think we attract about 120 billion in mega unis that got done, taking away from the BSL market over the last 2 to 3 years. 120 billion on a market that's 1.7 trillion is just scratching the surface. And direct lenders can now finance deals up to 5, 6, even 10 billion if they club their capital together. So I think there's a long runway, and sponsors and borrowers prefer to work with direct lenders in a lot of different ways. And so I think the future is, really positive over the next 3 years.
I would just quickly add to that, that the supply side, the supply side will grow significantly. We have a pause here, private equity, primarily because of denominator effect. But as it did after 2008, it takes about a year, most 2 years to clear up. Allocations to private equity are surging, particularly across the institutional market. If you're interested, there's a paper you can find on our website that talks about the parallel growth in both private equity and private debt. Anyway, thank you. Appreciate your time. Have a good rest of your day. Bye-bye.